My people, what's good? Hope you guys are all doing well. Thank you for tapping back in. I appreciate it. 100 Years of Wealth, streamhomeloan.com. Let's go ahead and dive into it. So, today's topic, what we're going to talk about is loans for real estate that are investment oriented, that are made for people that are looking to purchase properties for investment purposes. And really, the simple term for it is a rental property. And the loans, or at least one specific loan that's been very popular nowadays that everyone should be aware of, if at some point they plan on trying to buy an investment property, this loan may make your life a lot easier when purchasing that property. So the loan we're talking about today is a DSCR loan. DSCR loan. If you look back at my videos, I've probably touched on this topic before, but I want to make a specific video, updated video regarding this, just so everyone's aware. If you guys have any questions, put it in the comments, shoot me an email, kenneth@streamhomeloan.com. I've recently done multiple DSCR loans, as well as my company, different agents within the company have done many DSCR loans, and they're just more popular right now. This is probably a product that's come out in the last 5 years or so, or at least become more prevalent and prominent in the last 5 years. And now it's just become more of a staple product. So, DSCR, first, let's touch on what that actually means. The D is for debt, the S is for service, the C is for coverage, and the R is for ratio. So, in business and in financing, when you're talking about debt, a lot of times they use the term debt servicing, meaning what the cost is to pay for that debt, to cover that debt. And in simple terms, that's just the monthly payment on the debt. What is the monthly payment on a certain debt? And I guess that when you're looking at it in business terms, business financing, they call it service because you're the monthly payment. I don't know, but that's what it is: debt service coverage ratio. So they're looking at a loan. They're saying, what is the debt service on the loan? How much does it cost to service the debt monthly? And what is the coverage ratio? So, simple example: if there was a debt and the monthly payment to cover that debt was $5,000. Let's even be more simple: $1,000, and you had a income from the asset related to that debt of $1,000. That would be a 1% or a 100%, one for one debt service coverage ratio, because you are covering the entirety of the monthly payment at the exact amount. So it's a 1-for-1 ratio. If you're in a scenario where the payment on a debt was $1,000, but you are receiving $750 in income from that particular asset associated with that debt, that would be a 0.75% debt service coverage ratio, meaning that the coverage of that debt service is 75% of what the actual debt service is. So that is how DSCR home loans work. That's how people that are buying investment properties where there's rental income being generated, or rental income will be generated in the future, a lot of times they're using DSCR loans because it makes it a lot easier, and it's really qualifying the loan based on assets, down payment, credit, of course, but then the income that the property generates. So you could be a person that doesn't own a property, doesn't have your own property, and you are buying a property because you have the funds to put down, and that property, let's say that the property receives $1,000 a month in income, and then the mortgage payment that you're going to be that you're qualifying for is $1,000. You could purchase that property if you have the funds down, because the monthly income would cover that debt. So a lot of times it's going to be a little bit more complicated than that, in the sense of, if you go out and you look to purchase a 1 unit property, in today's market, if the property is already being rented, that could be a challenge, because a lot of DSCR loans are only going to go off of the actual rental income being received, and they're not going to be so concerned about like what the potential market rent is of that property, especially if there if there's a tenant in there. So I had a recent scenario where the property was vacant, and we did the loan, and we based the income number that we were using off of the appraiser's rent survey. So the appraiser goes out, does a traditional appraisal of the property, but along with that traditional appraisal of the property, they do a survey of rents in the area, and they find out what that particular property is likely to rent for, and then they give that number, and then that number will qualify as the income um, for that particular loan. And if that number that the appraiser comes up with is higher than the mortgage payment or at the mortgage payment, then that'll qualify that loan. So this loan is a great loan to for investors or for potential investors, because you don't have to have qualifying income on your own. It could really be based on just what the property produces. And I've seen these programs allow as little as 15% down, when in the past, investment property loans well, for one, FHA and VA don't do investment property loans, so you couldn't go that route. Conventional would require, and I think they still do require, 25% down on an investment property. So just think about how big of a barrier that was for a lot of people. And then on top of that, you got to make sure your debt to income ratios are very low. I think with conventional, you probably need to stay below a 45% debt to income ratio, which, it just creates an additional barrier to purchasing investment property. When you go with the DSCR route, in a lot of areas, rental income is up. A lot of areas, if you're putting a strong enough down payment, the remaining loan payment can be covered by the rent. And if you're only required to put down 15%, and they're not qualifying it based off of your income, they're qualifying it based off the rental income of the property, it creates an opportunity for a lot more people to be able to purchase a investment property. So um, some of the other factors with DSCR loans are going to be that they are usually going to require that you have reserves in the bank. When we say reserves, you're looking for months. Reserves are like, a traditional lender will say, we want you to have 3 to 6 months worth of reserves in the bank. And they're talking about your mortgage payment times 3 to 6 months. So if your mortgage payment's 5K and you've got 15K in the bank, there's 3 months worth of reserves. On some of these programs, they want 6 months reserves. Some of these programs, they want 12 months reserves. But that's really the lender's security to say, okay, we're going to be more flexible on this particular program. We're going to be more flexible, with down payment. We're not going to verify your income. We're going to go off of the rental income of the property. But our additional form of security is that we are documenting that you have 12 months worth of this payment in the bank somewhere. So, the lender, where there's flexibility, they usually add some other sort of security through, equity, higher down payment, or through higher reserve requirements, so that they know that this person, if shit hits the fan, this person has funds available to make their mortgage payment. Once again, giving them time to adjust to whatever changes are being made, whether it's employment, the renter leaves, the market's starting to take a crash for whatever reason. Reserves gives the client time to adjust. So, pretty simple. That's all I really want to say on that note. I think a DSCR loan is going to become more and more common. A lot of the programs want you to have that 1-for-1 ratio, meaning that the mortgage payment is completely being covered by the rental income coming in. But some programs will allow flexibility with that. They'll allow your mortgage payment to let's say, be covered 75% by the rental income, but then there's going to be adjustments to the down payment requirement. So, for example, if the mortgage payment's $1,000, but the rental income is $750 coming in, that's a 0.75, basically a 75% debt service coverage ratio. The lender might say, hey, instead of allowing you to put down only 15%, we're going to require a total of 25%, or possibly a higher down payment than that. So just trying to give you the ebbs and flows of how that particular program works. The best case scenario is to have rental income that covers the potential mortgage payment. And credit scores are usually going to be required to be 620 and above, probably a little bit higher actually. I have seen some programs where DSCR loans will be allowed for 620, but most of the programs I've seen are 640 and above. And the tighter the guidelines get, or the tighter the scenario gets, the more likely they're going to push that credit score requirement up, where you're 660, 680. So on that note, like and subscribe. Please let me know if you have any additional questions. Do your own additional research. DSCR loan. You can ask ChatGPT if you have that to give you a better explanation if you want one. But really, it's a loan where you're buying rental property, an investment loan. It falls under the category of like a business purpose loan. So it doesn't have the same type of requirements as like a conventional loan. It doesn't even have the same requirements for disclosures as conventional FHA and loans like that, because it is a whole different category of financing. It usually will work for properties up to 4 units or 4 units and above, because it doesn't have those same restrictions as a conventional loan. And they close just as quickly as your normal loan. What else can I say on that? Yeah, I think the main challenge when you're looking at buying investment properties, and I've mentioned this before, is that when I go out and I try to buy a 4 unit property in today's market, I am paying today's purchase price for that home. The renters in there may be in there for the last 3, 4, 5 years, and they're paying rent from a few years ago. And sometimes you have scenarios where landlords just never raised rent because either they felt bad, either they just felt like they didn't want to make an adjustment on a tenant that's paying the rent. I totally get it. I'm in the same position. But my point is that a lot of times you're buying a property at today's market, and the rents they don't correlate. You have to kind of go in with the plan of how I'm going to get the rents up, either through buying tenants out, improving the property, waiting till someone moves out to increase the rent on the next one, and go to market rent at that time. But nowadays, a lot of times you have to have a whole strategy. Sometimes if the rents are low on the property, you'll see that adjusted into the price. I see that more on like, you know, higher unit count buildings where you are looking at cap rates and capitalization rates, basically the amount of actual money you're making on the property, and you're looking at gross rent multiplier. So when you're looking at those numbers, those are usually numbers that you're seeing on 4 unit plus properties, or listings of 5 unit plus. Usually with 1 to 4 unit properties, you'll probably just see the rent listed. You might not see that type of commercial type of investor type of information, but you can calculate that on every property. The amount of money that you're making, the amount that's going to take, or the percentage of money that you're making, the amount of time that's going to take you to make your money back. And what you see is that a lot of times when you're buying one of these properties, your profit is delayed until you're able to make some of those adjustments. Get new tenants in, bump the market rent up, make improvements to the property. But that's part of the game, and part of, I guess, being a good investor is really finding properties that have the value add potential, have scenarios where either you can get the property so low that it makes sense to potentially give someone a fair buyout. So it's complicated, but at a minimum, knowing what loans are available and how they work is going to make you a more savvy investor. Because at the end of the day, especially with the way things are going, I don't know if we can trust Social Security. I don't know if that's going to be there. I think that one of the smart ways to retire is to have rental property. If you have rental property, you maintain your properties, you should be able to maintain a decent tenant base, and over time be able to grow your income at a fair rate. It's not about gouging people. It's about growing your income at a fair rate, maintaining your properties, and that should be able to create a secure residual income over time. And maybe if you want to be more hands off, you hand it off to a property manager, and you should be able to maintain a solid income and not really have as much worries attached to the market. So point is that I think that if you set a approach to acquire a rental property every few years, at a certain age, maybe over the next 20 years, you can have a handful of properties that are producing a little bit of income each that contribute to your overall retirement income. But DSCR loan, definitely a good loan to take advantage of. And the great thing is that you can use these loans in different states. This isn't just a California thing. And if you're a California person, which a lot of the people that I communicate with are, if you're in California, you can use these loans in other states. You don't have to be a resident, obviously, because it's going to be an investment loan. So even with our company, we're licensed in California and Texas, but we're able to lend on these products um, throughout the country because they are business purpose loans and they don't require the same licensing as residential loans. So you got interest in buying an investment property in Tennessee, holler at your boy. I can assist you in that. But any questions you have, once again, put them in the comments or shoot me an email at kenneth@streamhomeloan.com. Have a great day. 100 years of wealth, health, and happiness to you and yours. And cheers.